Hi everyone, in a rare move I'm going to begin this video by stating the conclusion, which I'll do in a few seconds. But first, just to outline what we're talking about, double performance ETFs, double long the market, which gives you 2 times the return on the upside, double short the market, so double inverse, which gives two times on the downside. And many people are complaining about the performance, the really piss poor performance that these funds have been putting in, and rightly so, because it's true. They're just not a buy and hold, but they are excellent as a short-term trading vehicle, providing you're prepared to dump them if things starts to go against you. But I'll explain all that later on. I'll explain why they're so weak, why people are justified in these complaints, and why they're just bad as a buy and hold. But first, this conclusion that I mentioned, which is that instead of buying the double long ETFs, hoping the market will go up, it's actually more effective to short the double inverse funds, because you get the equivalent situation, because you're shorting one that is an inverse, and therefore if the market goes up then you gain, but also you gain from the inherent weakness in that fund, which is backed up by the fact that right now there are no shares to borrow in some of the double inverse funds on the indexes, yet there are plenty of shares available to borrow on the double long funds. So that, I think, maybe tells us something. And maybe you'll come to the conclusion, as I did, that it's worth looking into possibly shorting both the double long and double inverse, because if they're both so pathetically weak as a buy and hold, then over time, if you short them both, you're kind of hedged against wherever the market goes, but gaining on the weakness. Now, I don't know if that will pay off, particularly as some of these funds pay dividends, and of course shorts have to pay the div. But watch this video, see what you think. Okay, let's look at an example where the underlying stock is trading sideways within a range. In this particular example, it's moving between $10 and $15 over a period of time. Now, this is an extremely exaggerated example, because each move on the chart represents one day, and so this stock would be moving from 10 to 15, back to 10, back to 15 every day. It would be a nightmare. But it's the volatility which creates the problem that I'd like to show you with the double ETFs and the double inverse ETFs, which we'll get into later. Okay, so as an investor in the double ETF, what might one expect to see on our own chart if the underlying is behaving in this fashion? Maybe something like this. Or maybe we'd hope for something like this. The reality, I'm afraid, is extremely disappointing. Here's how that nightmare works out. Our $10 stock moves 50% to $15. It's the 50% move which is doubled on the ETF to create a move from $10 up to $20. Now then, the underlying stock is at $15. It then moves back down to 10, a $5 move again. However, the percentage is different. The percentage is $5 out of 15, which is a 33% move. Double that 33% move to calculate the change in the double ETF, and we have a 66% move, which takes the stock all the way down from $20 to $6.67. The next move for the underlying is from 10 to 15 again a 50% move, which creates a double in the double ETF. However, it's only doubling from 667, which takes it only back up to 13.34, not even equaling the price at which the underlying is now trading again. This situation continues when the underlying drops back down to 10. Again, that 33% move is doubled to 66, this time from 13.34 for the double ETF down to 4.45, and on and on. It's an absolute nightmare. But don't forget, this is an extremely exaggerated version. But I think we can agree that it would be pretty damn disappointing to see this chart representing how our account was going if we were invested in a double ETF. Unfortunately, there's an even more potentially horrendous situation that we need to discuss. Taking our previous example of a stock which started trading at $10, but this time, instead of it moving up and down by $5 each day, let's use a percentage. So each day the stock moves up 10% and then down 10%, up 10% and then down 10%. Unfortunately, this in itself, even in the underlying, produces rather a disappointing chart for this reason. Let's say that we start at 10 and make a 10% move up. That takes it up to $11. However, when this stock makes a 10% move down, it breaks that $10 barrier. The reason being that 10% of $11 is $1.10, taking it back down to $9.90. The next 10% up move is only based upon a price of $9.90, which is 99 cents. Therefore, it fails to take out the previous high. Of course, the next down move of 10% is from the lower price again, and so on, hence into that awful downtrend.